Dan Frishberg is Chief Investment Strategist at Frishberg.com. He joins us live out of New York. Dan, great to see you again. We'll get to oil in just a bit, but you know, the other thing to wait on the market, GE shares, parent company of this network, were down very sharply, down about 8% or so. S&P coming out and cutting the outlook. You know, on GE, I guess this is a tentative step towards potentially cutting its AAA credit rating. Does this concern you? I mean, this centers around worries about funding at of course, GE Capital.
Well, you know, when they say we might eventually lower it over the next couple of years, look, most likely a lot of what is going on right now is not going to be happening in a couple of years. So I don't know if they will ever get around to the downgrade, but I don't know how they could use more tentative or weaker language to describe that they see something there, but they're not too worried. They don't know what they think. Look, here's the problem. GE is very reliant on commercial paper, and when the Fed intervenes so much, and our government intervenes so much, they create all kinds of unintended consequences. By lowering the interest rates as much as they did on the Fed funds rate, they leave no room for money market funds. They're not paying anything. They can't pay dividends. So now the money market funds are the ones who normally buy commercial paper. The Fed has been very concerned about commercial paper. They've been in there buying it, but the markets were getting to actually be pretty healthy, and they were buying about $40 billion worth of commercial paper last week. Now they're going to grind that one to a halt by making the money market funds not work. So look, the dynamics are not particularly good, but this is really a non-downgrade.
Okay.
In a couple of years, GEs will either be gone or not have problems.
Woo. Okay, I tell you, let's move on and talk about what's going on in oil. Yesterday's session down 8%, overnight session down almost 10%. We're looking at $36 oil, even though we had OPEC coming out and saying, look, guys, we're going to come out with we're going to do our biggest production cut ever, 2.2 million barrels. What's the worry here that demand is being destroyed so fast that even these cuts are not enough, or is it more that OPEC is not going to be able to deliver?
That's more like it. The lack of credibility. And I'll tell you why. Our analysis is this. The United Arab Emirates and Qatar can actually exist on $40 oil, $35 oil, and do all right. Saudi Arabia says they can do it at 30, but we think it's more like 50. And the rest of the countries can't make it, and the big ones that are in trouble are Russia, Iran, Venezuela. Those are they need $70 oil, and they need it at the level that they were producing before. So they can't afford to cut back. So what they're really asking for is for OPEC to cut back, but then let them cheat so that they can stay alive. I don't really think Saudi Arabia has anything to gain by a deal like that. Yeah. And so the whole thing really has no future. They don't really have the pricing power. That's the deal.
Yeah. All right, Dan, we'll come back and talk more in just a bit. Dan Frishberg from Frishberg.com.